In the evolving landscape of global commodities trading, moments of extreme profit rarely emerge from coincidence. They are typically the result of disciplined macroeconomic interpretation, precise execution timing, and a willingness to challenge dominant market narratives. Within this environment, a Chinese commodities trader quietly constructed one of the most profitable precious metals trades of the decade, generating approximately $3 billion through a highly calculated gold strategy. His subsequent decision to position heavily against silver would later raise significant questions among institutional investors and commodity analysts worldwide. The trader's ascent occurred during a period of intensifying global financial uncertainty. Major economies were confronting historically high sovereign debt levels, while central banks were increasingly deploying aggressive monetary expansion policies. These policies, designed to stimulate growth and stabilize financial systems, simultaneously introduced long-term concerns regarding currency debasement and purchasing power erosion. Precious metals, historically viewed as monetary hedges, began attracting renewed institutional attention. Unlike many market participants who responded reactively to price momentum, the trader approached commodities through structural economic interpretation. His early career was rooted in domestic Chinese futures markets, where he developed an understanding of supply chain economics, industrial demand forecasting, and government policy influence on commodity pricing. Over time, his methodology evolved toward a broader macroeconomic framework, emphasizing the interaction between monetary policy, global liquidity cycles, and geopolitical risk escalation. His transition into international commodity trading circles occurred gradually. Rather than pursuing rapid speculative growth, he built credibility through consistent analytical accuracy. Industry observers noted his preference for data-driven positioning, supported by macroeconomic indicators such as central bank reserve accumulation, cross-border capital flows, and currency volatility metrics. This analytical discipline would later define his gold trading strategy. The opportunity that ultimately produced his multi-billion-dollar gain emerged as global monetary authorities accelerated gold accumulation programs. Several central banks began increasing their gold reserves as a hedge against currency instability and geopolitical fragmentation. Simultaneously, global debt expansion reached levels that raised concerns about long-term fiscal sustainability. The trader interpreted these developments as early indicators of a prolonged precious metals bull cycle, driven less by speculative demand and more by institutional monetary realignment. His execution strategy demonstrated an advanced understanding of market psychology. Rather than entering the gold market during periods of peak investor enthusiasm, he accumulated positions during phases of skepticism when price momentum appeared uncertain. This approach allowed him to secure favorable cost bases while minimizing competitive positioning pressure. He utilized a combination of physical gold exposure and derivative contracts, balancing liquidity flexibility with long-term asset security. As gold prices began rising in response to macroeconomic instability and geopolitical tensions, his positions appreciated rapidly. The convergence of institutional demand, currency uncertainty, and safe haven investment flows accelerated gold's upward trajectory. The trader's early positioning allowed him to capture the majority of the price expansion cycle, transforming his strategy into one of the most profitable commodity trades of the period. The scale of his financial success elevated his status within Asian trading institutions and global commodity investment networks. However, his influence extended beyond financial achievement. Market participants began examining his analytical framework, attempting to identify whether his forecasting methods could reveal future commodity cycle transitions. His public communications remained limited, but institutional observers increasingly monitored his trading signals as potential indicators of broader market shifts. It was during the peak realization phase of his gold profits that the trader began directing analytical attention towards silver. Historically, silver has exhibited a strong correlation with gold due to its dual role as both a monetary metal and an industrial commodity. Traditional valuation models often relied on the gold-to-silver ratio to identify relative pricing equilibrium between the two metals. For decades, investors assumed that sustained gold rallies would eventually generate parallel silver appreciation. However, the trader identified subtle irregularities within this relationship. Despite gold experiencing strong institutional accumulation, silver's price behavior demonstrated increasing volatility and inconsistent performance patterns. Industrial demand indicators suggested growing dependence on manufacturing cycles rather than purely monetary investment flows. These observations prompted deeper examination of silver's structural market dynamics. His research revealed emerging divergent signals within supply chains, futures market liquidity structures, and industrial consumption dependencies. These signals suggested that silver might no longer function as a direct monetary proxy to gold during periods of economic stress. Instead, silver appeared increasingly vulnerable to global economic slowdown cycles that could suppress industrial demand, while gold maintained its role as a monetary hedge. The trader's gold success provided both financial resources and analytical confidence to explore this divergence further. He recognized that major commodity fortunes are rarely generated by following established correlations. Instead, they are often created by identifying structural breakdowns in historical relationships before broader market recognition occurs. By the time global investors began celebrating the magnitude of his gold profits, the trader had already shifted significant analytical focus toward silver. His transition from gold accumulation to strategic silver opposition marked the beginning of a new macroeconomic thesis, one that would challenge traditional precious metals investment assumptions and potentially signal deeper structural changes within global commodity markets. The significance of this transition extended beyond individual trading success. It introduced the possibility that precious metals markets were entering a new phase of fragmentation, where historical pricing relationships could no longer be relied upon as stable forecasting tools. For institutional investors, corporate strategists, and commodity-dependent industries, this emerging divergence represented a warning signal demanding careful evaluation. The trader's rise, therefore, was not simply the story of a successful commodity speculation. It represented the evolution of a macroeconomic strategist whose analytical discipline allowed him to detect shifts in global financial architecture before they became widely recognized. His next move, positioning heavily against silver, would test whether his understanding of structural market transformation extended beyond a single profitable commodity cycle. Today, we're diving deep into a topic that many of you have asked about: the fascinating and often misunderstood relationship between gold and silver. For centuries, these two precious metals have been seen as financial twins, moving in tandem. But if you've been watching the markets lately, you might have noticed something strange. Their paths are starting to diverge, and today, we're going to explore exactly why. This isn't just random market noise, it's a structural shift, and understanding it could be key to your investment strategy. So, let's start with the basics. What's the traditional view? Historically, gold and silver have had a strong positive correlation. When gold goes up, silver usually follows, and vice versa. This relationship is often measured by the gold to silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold. For a long time, this ratio has been a reliable indicator for traders. When the ratio gets high, it suggests silver is undervalued relative to gold, and when it's low, gold might be the better buy. Simple, right? But the world is changing, and so are the fundamentals of these two metals. The biggest driver of this divergence is their industrial versus monetary roles. Think about gold. What is its primary function in the modern economy? It's overwhelmingly a monetary asset. It's held by central banks as a reserve. It's stored in vaults as a hedge against inflation and economic uncertainty. It's a safe haven asset. While it has some industrial uses, particularly in high-end electronics, that demand is a tiny fraction of its total market. Gold's value is deeply tied to financial sentiment, interest rates, and the strength of the dollar. Now, let's look at silver. Silver has a dual personality. Yes, it's a monetary metal, a poor man's gold, and people do buy it for investment and as a store of value. However, unlike gold, silver has a massive and growing industrial demand. We're talking about a critical component in some of the world's most important technologies. It's in your smartphone, your laptop, and the solar panels on your roof. Its incredible conductivity makes it essential for electronics and green energy. In fact, over half of all silver consumed each year goes directly into industrial applications. This is where the story really gets interesting. The global push towards decarbonization and green energy is creating an unprecedented demand for silver. Every solar panel manufactured needs silver. As countries around the world commit to building out their solar capacity to fight climate change, the demand for physical silver is set to skyrocket. Similarly, the electric vehicle revolution is another huge catalyst. EVs use significantly more silver than traditional internal combustion engine cars. From the complex wiring to the advanced sensor systems, silver is everywhere. This isn't speculative future demand. It's happening right now, and it's accelerating. So what we have is a tale of two markets. Gold's price is largely dictated by investment flows and macroeconomic factors. It acts as a barometer for fear and uncertainty in the financial system. Silver, on the other hand, is increasingly being driven by physical supply and demand dynamics from industry. While investment demand still plays a role, the industrial side is becoming the dominant force. This means that even if gold stagnates due to a stable economic outlook, silver could see its price surge simply because there isn't enough of it to meet the needs of manufacturers building solar panels and electric cars. This structural split is causing the old gold to silver ratio to become less reliable as a trading signal. We're entering a new paradigm where silver's value proposition is fundamentally changing. It's shifting from being primarily a monetary asset to a critical industrial commodity with monetary properties. This divergence presents both challenges and opportunities. For investors who only look at the historical correlation, they might miss the bigger picture. But for those who understand this underlying structural shift, it could unlock new possibilities. The story of silver is no longer just a footnote to the story of gold. It's becoming its own headline. By the time the Chinese trader finalized his structural divergence thesis between gold and silver, the challenge shifted from analysis to execution. Identifying macroeconomic imbalances represents only one phase of institutional commodity trading. The far greater test lies in constructing positions capable of capturing the anticipated divergence while minimizing exposure to unpredictable market reversals. The trader RAS strategy required a multi-layered risk architecture designed to isolate relative performance differences between the two metals rather than relying on absolute price collapse scenarios. His initial focus centered on quantitative risk modeling. The trader assembled an analytical framework integrating macroeconomic forecasting, industrial demand modeling, liquidity cycle projections, and derivatives market positioning data. Instead of constructing a direct short exposure to silver, he structured his position through spread trades that simultaneously maintained bullish exposure to gold while establishing bearish leverage against silver. This methodology allowed him to capture valuation divergence between the two assets while reducing directional risk associated with broader precious metals price fluctuations. The trader's modeling process incorporated historical volatility comparisons between gold and silver across multiple economic cycles. Silver historically demonstrates higher price sensitivity to liquidity contractions and industrial demand shifts. By analyzing decades of market performance, he identified periods where tightening monetary conditions disproportionately affected silver prices relative to gold. These historical precedents supported his thesis that silver-Tserskin's hybrid industrial dependency created amplified downside vulnerability during liquidity stress periods. Timing the execution of such a position required careful monitoring of macroeconomic trigger indicators. The trader closely followed global interest rate trajectories, particularly shifts in major central bank monetary policy. Rising interest rates historically reduce speculative capital flows into leveraged commodity markets. As monetary tightening signals strengthened, the trader interpreted these developments as early confirmation that liquidity-driven speculative demand for silver could weaken significantly. Currency volatility also played a central role in his execution timeline. The trader monitored fluctuations in major reserve currencies, recognizing that precious metals often function as hedges against currency instability. However, he observed that during periods of dollar strength and global liquidity tightening, silver's industrial sensitivity frequently outweighed its monetary hedge characteristics. These observations reinforced his decision to gradually expand his silver short exposure during phases of strengthening global reserve currencies. Another key trigger involved manufacturing and industrial output indicators. Silver demand remains closely linked to global production sectors, including electronics manufacturing, renewable energy infrastructure development, and advanced technology component fabrication. The trader tracked leading manufacturing indices, export data from major industrial economies, and capital expenditure projections from global technology firms. Early signs of slowing industrial expansion further strengthened his conviction that silver demand could weaken despite continued monetary demand supporting gold. Market reaction to his positioning introduced immediate challenges. Institutional commodity participants maintained strong historical belief in silver as its eventual convergence with gold during precious metals rallies. Retail investors and speculative traders frequently viewed silver as a high volatility alternative to gold, expecting it to generate amplified gains during bullish precious metals cycles. This widespread sentiment created resistance against bearish silver positioning and increased short-term volatility during the early stages of the trader EOS execution strategy. Volatility spikes created by market skepticism required disciplined capital allocation adjustments. The trader avoided concentrated entry points, instead scaling his silver exposure through phased position construction. This gradual accumulation minimized market visibility and reduced vulnerability to short-term price squeezes triggered by speculative counterpositioning. His execution strategy emphasized liquidity preservation and long-term divergence capture, rather than immediate price reaction. Liquidity stress and margin dynamics represented the most critical elements of his strategy. Silver futures markets operate with significantly higher leverage participation compared to physical precious metals investment markets. This leverage introduces amplified price movement potential during margin pressure cycles. The trader analyzed leveraged position concentration data within futures exchanges, identifying periods when speculative long exposure approached historically elevated levels. During these periods, even minor price declines could trigger cascading margin calls, forcing leveraged participants to liquidate positions rapidly. The trader structured his bearish silver exposure to benefit from these liquidation cascades. By maintaining sufficient capital reserves and hedging exposure through gold long positions, he positioned himself to withstand temporary volatility while capturing accelerated downside momentum generated by forced market exits. The interaction between futures market positioning and physical silver availability further supported his strategy. While silver paper trading volume expanded rapidly, physical delivery availability remained constrained by fragmented supply chains and industrial consumption commitments. The trader interpreted this imbalance as a potential volatility catalyst. If futures market participants attempted to convert leveraged positions into physical delivery during liquidity stress, supply constraints could trigger price dislocations that amplified volatility cycles. Strategic communication also played a subtle but significant role in the trader's execution process. Unlike speculative traders who publicly promoted directional positions, he limited external disclosure of his silver thesis. Instead, his analytical insights circulated selectively through institutional trading networks, hedge fund advisory discussions, and commodity strategy briefings. This controlled dissemination allowed market awareness of his positioning to develop gradually without triggering immediate speculative counteraction. As his silver strategy expanded, institutional observers began analyzing his position as a potential indicator of broader commodity cycle transformation. Commodity hedge funds monitored his trade structure, recognizing that relative precious metals positioning could signal shifts in global liquidity patterns. Some institutional investors cautiously adjusted portfolio allocations, reducing silver exposure while maintaining or expanding gold holdings. Despite growing attention, the trader maintained strict adherence to risk management protocols. He continuously monitored cross-asset correlations, ensuring that unexpected macroeconomic developments did not compromise his divergence thesis. His strategy incorporated dynamic rebalancing mechanisms, allowing adjustment of gold to silver exposure ratios in response to evolving market conditions. This flexibility protected his positions from excessive concentration risk while preserving core strategic objectives. The execution phase demonstrated that macroeconomic trading success relies not solely on analytical accuracy, but on disciplined capital deployment and psychological resilience. Silver markets experienced periodic rallies driven by speculative enthusiasm and industrial optimism, testing the trader's conviction. However, his adherence to structural analysis allowed him to maintain positioning through volatility cycles without abandoning his core thesis. By successfully constructing a relative trade framework isolating silver's structural vulnerability, the trader positioned himself to potentially capitalize on one of the most controversial commodity divergence trades in recent financial history. His strategy illustrated the sophistication required to transform macroeconomic forecasting into executable institutional trading operations. More importantly, it suggests that silver's performance trajectory could serve as a broader indicator of emerging instability within global industrial demand cycles and leveraged commodity market structures. As the scale of his silver exposure increased, the implications of his strategy extended beyond individual trading performance. Market participants began recognizing that if his divergence thesis proved accurate, it could signal deeper structural transformation within global commodity pricing mechanisms, with potential consequences extending into industrial production forecasting, investment portfolio allocation, and global economic stability analysis. Global economic implications of a silver downtrend days. The Chinese trader expanded his bearish positioning against silver. The implications of his strategy began extending beyond the boundaries of commodity speculation. Within institutional financial circles, large-scale relative commodity trades are rarely interpreted as isolated investment decisions. Instead, they are frequently viewed as diagnostic signals reflecting deeper transformations within global economic structures. The trader's silver thesis gradually attracted attention not simply because of its contrarian nature, but because of what it suggested about industrial demand cycles, global manufacturing stability, and systemic liquidity vulnerabilities. Silver has long functioned as a sensitive indicator of industrial expansion. Unlike gold, whose primary demand drivers originate from wealth preservation and monetary reserve accumulation, silver consumption remains deeply embedded within global production systems. The metal serves as a critical input in electronics manufacturing, renewable energy infrastructure, medical technologies, telecommunications equipment, and semiconductor fabrication. As a result, sustained weakness in silver demand frequently signals early contraction phases within industrial activity before broader economic data confirms the slowdown. The trader Lauer-S analysis suggested that silver price deterioration could function as a forward-looking indicator of manufacturing stress. Industrial production historically responds quickly to shifts in global credit availability, capital investment cycles, and consumer demand expectations. When corporations begin reducing capital expenditure or scaling back expansion projects, silver consumption often declines before the broader economy reflects contractionary signals. For business leaders and policymakers, such early commodity demand shifts can serve as critical forecasting tools for economic planning and risk mitigation. The potential consequences of declining silver demand also extend significantly into emerging market economies. Several developing nations maintain heavy reliance on silver mining exports as a major component of national revenue generation. Reduced silver profitability can introduce fiscal strain within these economies, particularly in regions where mining employment represents a substantial portion of local labor markets. Currency volatility often accompanies commodity export revenue declines, creating secondary financial pressure on domestic banking systems and sovereign debt stability. Historically, commodity price contractions have contributed to political instability in resource-dependent economies. Reduced mining revenue can weaken government fiscal capacity, limit infrastructure investment, and increase social inequality within mining communities. The trader's silver thesis, therefore, raised concerns among global economic observers that a prolonged silver downtrend could amplify geopolitical risk within several emerging market regions. These risks extend beyond local economic disruption and can influence global supply chain reliability, foreign investment flows, and regional security stability. Institutional investment portfolios also face potential recalibration as silver's structural vulnerability became more widely discussed. Hedge funds, sovereign wealth funds, and global asset managers traditionally allocate precious metals exposure as a diversification and risk management strategy. Silver's historical correlation with gold made it an attractive portfolio balancing instrument, particularly during periods of currency uncertainty and inflationary pressure. However, the trader ES divergence thesis suggested that silver might no longer provide consistent monetary hedge characteristics under evolving economic conditions. This realization encouraged institutional investors to reassess precious metals allocation models. Many began increasing emphasis on gold as a defensive reserve asset due to its liquidity stability, central bank accumulation support, and reduced industrial demand sensitivity. Simultaneously, silver allocation strategies shifted toward more cyclical commodity investment frameworks rather than long-term monetary preservation positioning. This portfolio reallocation trend further reinforced pricing divergence between the two metals, potentially accelerating structural transformation within precious metals investment strategies. The trader's silver strategy also introduced concerns regarding financial market contagion risks. Modern commodity markets operate within complex interconnected derivative frameworks that link futures contracts, options markets, exchange-traded funds, and cross-asset leverage financing structures. Significant price volatility within a major industrial commodity can propagate instability across broader financial markets through forced liquidation cycles and collateral revaluation pressures. Silver futures markets, in particular, demonstrate high leverage participation compared to many other commodities. If sustained price declines trigger margin liquidation cascades, leveraged market participants may be forced to unwind positions across multiple asset classes to satisfy collateral requirements. Such cross-asset liquidation pressure can introduce volatility into equity markets, currency markets, and fixed income securities. The trader AS thesis, therefore, highlighted the possibility that silver price weakness could function as a catalyst for broader financial market instability during periods of tightening global liquidity. Another important implication of silver divergence involved global renewable energy investment projections. Silver remains a crucial material in photovoltaic solar panel production, playing a significant role in global energy transition strategies. Sustained price weakness in silver could initially reduce manufacturing input costs, potentially accelerating solar infrastructure expansion. However, prolonged market instability could discourage mining investment, eventually constraining long-term supply availability. Such supply disruption risks could create future price volatility cycles, complicating long-term renewable energy planning and industrial supply chain stability. For corporate strategists and business leaders, the trader's silver thesis introduced broader strategic lessons regarding commodity cycle monitoring. Commodities frequently serve as early indicators of macroeconomic transformation because they directly reflect real production demand and supply chain stress before financial markets fully recognize structural changes. Monitoring divergence patterns between related commodities can provide valuable insight into shifting economic fundamentals and emerging industry risk factors. Entrepreneurs operating within manufacturing, technology, and energy sectors must particularly recognize the importance of commodity price analysis as a forward economic intelligence tool. Declining silver demand may signal reduced consumer technology production forecasts, slowing infrastructure investment, or tightening global credit availability. Businesses that integrate commodity cycle analysis into strategic planning can improve operational resilience by anticipating demand fluctuations and adjusting capital allocation accordingly. The trader's approach demonstrated that macroeconomic forecasting extends beyond predicting financial market movements. It requires understanding the interconnected relationships between resource demand, industrial expansion, monetary policy, and geopolitical stability. His silver positioning illustrated how sophisticated commodity analysis can reveal systemic economic vulnerabilities before traditional economic indicators confirm emerging instability. As institutional awareness of silver's structural transformation continued expanding, the trader's strategy began influencing global commodity market psychology. Market participants increasingly questioned whether long-standing pricing relationships between monetary and industrial commodities could remain reliable under modern economic complexity. The possibility that precious metals markets were entering a fragmented structural phase introduced uncertainty into traditional commodity forecasting models. Ultimately, the trader's silver thesis represented more than a contrarian investment position. It functioned as a warning signal highlighting the fragile balance between industrial growth, financial leverage, and monetary stability within the global economy. If silver's divergence from gold proved sustainable, it could confirm that global commodity markets were undergoing a fundamental transformation driven by technological evolution, industrial restructuring, and shifting monetary frameworks. For decision makers across financial institutions, corporate enterprises, and government policy agencies, the trader's strategy underscored the necessity of continuously reassessing historical economic assumptions. Commodity markets do not merely reflect economic activity. They frequently anticipate structural transformation long before conventional economic data reveals systemic change.